Welcome back, everybody. My name's Jeff, and today I want to try and make your life a little easier. I want to do that by making your retirement journey just a little simpler, because I know that retirement planning can seem a little complicated. There's lots of moving parts, tax law changes every few years. It could be a little overwhelming. So instead of focusing on the hard and just complicated parts, let's just focus on the basics today. Let's go over 4 ways to make your retirement easy and simple. So first up, know your worth. I do this with all my retirement planning clients. First thing you've got to do when putting together any retirement plan, you need to know how much money you have, also called your assets, and how much money you owe, also called your liabilities. Your assets minus your liabilities, that's your net worth. Here's an example net worth statement from a sample client. You could see all of their assets listed out, checking accounts, saving accounts, retirement accounts, primary home. You could also see just they have one liability, their home mortgage. And look, listing all this stuff out, it's super easy. It's a simple thing to do. And it's pretty much step 1 in putting together a retirement plan. I mean, if you don't know where all your money is, it's kind of difficult to gauge whether or not you're ready to retire. So get your ducks in a row and then build out your net worth statement. Next up, consolidating. Now, most people are going to work for 3, 4, 5, or even a dozen or more employers throughout their working years. You might even, switch banks maybe a few times. And the result is naturally you're either just going to leave some money sitting in an account that you never use, or you leave behind a retirement account you contributed to in the past that you just kind of forget about. For example, looking at our net worth statement here, again, you could see that Ezra here, he has 3 different retirement accounts or 401ks that he has from previous companies that he's worked. Now, Ezra, he has the option to consolidate his retirement accounts. He can move or roll over all 3 accounts into a single rollover IRA, or he can roll it into his current employer's 401k if his current employer allows it. Regardless of where the money is kind of rolled over into though, I feel it's just way easier to kind of keep track of your money when it's just all consolidated and combined rather than having it sit out there. This also makes managing your investments way easier. For example, when you leave behind a 401k after you leave an employer, you have to remember that you're now responsible for making sure the investments are set up according to the plan. Sometimes an employer will switch custodians or a TPA, or they'll just switch the investments inside the plan. It can be kind of a pain to track and manage all of that. So kind of consolidating all of your retirement plans can really make life a lot easier. And speaking of making things easy, this next one also gets neglected a ton, and it has to do with estate planning. Even before you decide to consolidate and move any money around, I would check all of your beneficiary designations on your accounts. Cannot stress this enough. This takes only a few moments and will make your beneficiaries' lives infinitely easier by just making sure your accounts have the right beneficiary listed. Now, I'm not an estate planning attorney, and this certainly isn't legal advice, but with that said, generally speaking, assets that pass on to heirs that don't have beneficiaries named to them, they pass through the estate and ultimately a process called probate. It's an ugly process. It sometimes takes years to settle, and it's very expensive since you usually have to get lawyers involved. You can try to avoid all of this by setting up an estate plan with an estate planning attorney, which is super easy advice to give. I mean, talking to an estate planning attorney to make sure your estate passes to your heirs efficiently, that's not exactly a crazy thing to say, but I know the reality is talking with an attorney takes time, takes money, and knowing most people, you're going to drag your feet a little bit. I know estate planning is a touchy subject. It's not fun to talk about our demise and whatnot. So because of that, I would recommend at the very least, and for the sake of kind of keeping on our theme of simplicity and ease, update your beneficiary designations on your financial accounts right now. Next up, calculate your burn rate. Now, your burn rate is basically how much money you're spending. It's the expense side to your budget. This is important because the expenses you need, that's going to drive how much money you need from outside sources like your investments, Social Security, a pension while you're in retirement. So with that said, what's that number to you? If you're not sure, a good starting point will be to look at your current spend rate. If you don't already know this, maybe put together a budget and begin the process of kind of looking at where your money is being spent. You could use that as a starting point for your budget in retirement. But remember now, many items in your budget might not be in your retirement budget. For example, your savings. you're not saving anymore, you're in retirement. So if you were saving 10 to 20% of your salary every year, you of course don't have to factor in that cost or that outflow of cash. Also, your mortgage. You might have already paid off your mortgage before retirement, or you might have it paid off sometime in retirement and will therefore see a bump in kind of free cash flow during that time. At the same time though, you're gonna have more expenses in other areas. For example, travel. Travel is a pretty common expense that's increased in retirement, whether it be traveling to see family and friends or just general vacations across the world. You'll definitely see a bump in overall travel costs. Another increased cost is healthcare. This might be an obvious one. As you age, healthcare gets to be more and more expensive. You're covered by Medicare, but Medicare doesn't exactly cover everything. There's out-of-pocket costs, IRMA surcharges, and oftentimes some medical services might not even be covered by Medicare. There's one big event that's healthcare related that can be very expensive, and that's long-term care. Now, for the sake of keeping things kind of simple in this video, like the video suggests, we won't go into the details on long-term care, but just know it's an expense you'll potentially have to pay for in retirement that you're probably not paying for right now unless you have a long-term care insurance policy. And that's all I've got for you. If you want to chat more with me one-on-one, feel free to click the link in the show notes to schedule in some time to chat in a complimentary consultation. I'll see you there.